Hi, everyone. Since we're very few, I would invite you to come in to the front, a little bit closer. That's okay. Okay. I think you're fine. Great. So thank you guys for coming here today, joining me and Christian Winfer, the CEO of Grand City, to discuss convertible bonds as a financing option for corporates. Before we start, I just wanted to let you know that we have to leave at 12 on the dot, as we have a flight to catch to New York at 1:20. So convertible bonds, I'm going to start first of all by introducing myself very quickly, and then I'll let Christian introduce himself and Grand City, and then we're going to do it in a way of a Q&A between the two of us, and we'll go through the different points that you'll see in the presentation. And hopefully we'll have time for some questions from you guys. Otherwise, please feel free to get in touch with both of us via email or call us if you have any further questions afterwards. Great. So my name is Faiza Belgroun. I spearhead the equity-linked business within Berenberg. I've been working in the field for the last 8 years. Convertible bonds has been quite an interesting product since 2008, I must say. We've seen a lot of cycles throughout the different stages that we experience in the capital markets. And it has gone through ups and downs, but has always been of interest to many people, especially corporates who are trying to look into financing options, who don't necessarily have access to capital markets, depending on the market environments. Christian will tell you a little bit more about himself and Grand City and their experience within the product, and then we can go through a few questions to tell you a little bit more about what it is and why companies use it.
Just a very quick word on Grand City Properties. It's a company that has been around since 2004. It's a company listed since 4 years by now, which has grown very successfully to 80,000 residential units with a run rate rental income of 425 million euros. The company has a market cap of a bit under 3 billion at the moment. And I'm with the company since a good 4 years now. I'm since 8 years with the group which is behind it. And the company is specializing on acquiring neglected assets in good locations and does the workout, does a turnaround on these assets, and subsequently creates a yield which is almost double than the average yields of the typical property companies that you find in Germany. And for financing purposes, obviously, we are looking at all instruments that are available in the market, including convertible bonds.
So as I was saying, convertible bonds have always had a reputation for being a complex product. I think it's an unfortunate reputation and undeserved. If you look at it from a basic point of view, convertible is only a normal corporate bond that gives its holder the option to convert or exchange the bond into a certain number of shares that's defined at the very beginning at issuance. So this is just like a very basic description of what a convertible bond is, and we can kind of base everything from this basic, a bond component plus a conversion option. And the value of the convertible bond would be the highest of the two values. Christian, shall we start with our Q&A? Perfect. So would you be able to tell us what's the process in selecting the right sorts of financing when Grand City is thinking about it, and what convertible bonds play in that selection process?
In general, we are using all types of financial activities, straight bonds, hybrid notes, convertible bonds, bank loans, so the whole spectrum. In selecting the ideal financial instrument, timing is of the importance, market demand, capital structure of the company itself. We are keen to maximize the returns for our shareholders and at the same time further improve our rating with Standard & Poor's and Moody's. And therefore, we are keeping a very conservative financial structure, a low risk profile, and ultimately want to achieve an A global rating. So whatever we do in the capital markets, including convertible bonds, is something that we typically liaise with the rating agency before we do it in order to be sure that it doesn't affect our rating. And the reason we try to improve our rating is to ultimately achieve longer-term loans, longer-term bonds at the same good low interest rates that we are having today going forward.
Great. So what would you say are the circumstances in which you would favor a convertible bond over a straight bond, for example?
Well, we are generally focused on long-term debt, as I just mentioned, and we are trying to reduce the payment dependency with, at the same time, maintaining very conservative financial ratios, very low interest rates, and with a high probability of it being converted into equity. A straight bond you have to pay back sooner or later. A convertible bond will convert, will become equity, and subsequently that's a lot easier for the company. Absolutely.
And when would you prefer to issue, do a capital increase rather than issue a convertible bond?
Capital increases are situations where you get very fast money if the company is in a very strong and fast growth mode. But capital increase has a more immediate dilution effect than the convertible bond does. And investors are not as happy as they are with convertibles. If you do capital increases, you normally get a bit of feedback when you do this. But for growth on a very short period, it's good. But otherwise, a convertible bond is a more amenable product vis-à-vis your investors.
Yes, so I would say in general, in terms of how corporate think about convertible bonds, the two main reasons that a company would issue a convertible bond over a straight bond or equity would be the lower coupon rate. So your interest rate, you're keeping your cash outflow is very low, and the reason convertible bonds have a low interest rate is because you're giving away the convertibility optionality to your investor. So the holder is happy to get a lower interest rate with the optionality of having to convert the bond afterwards in throughout their life. And then secondly is also you're selling your equity at a premium with a delayed period of time. So rather than issuing stock today, doing a capital increase at X price, you'd sell it via the convertible bond in the future with typically today would be a premium of 45%. So that's a win-win if you have a certain view with your, within your company. When you see the stock growth going to a certain rate, and you don't want to give it all away to equity investors. So that's pretty much how people think about that. Christian, question for you actually. The majority of convertible bond space is a non-rated space, and we don't have many investment grade issues or rated bonds. So why Grand City is very keen to have their bonds rated and achieve the A-?
Number one, as I alluded already earlier on, the company is presently rated BBB, and we are working on a financial risk profile with Standard & Poor's, which is intermediate, allowing us a LTV up to 55%. Company policy is 50%. We want to keep that very conservative. Trying to get a better rating, BBB-, has to do with the duration of the bonds that we can get, mainly, so we can get longer-term finance locked in at the very good interest rates that we are getting today. On our last straight bond, we had 1.5% interest or coupon. On our convertible that we just did, we had 0.25%, trading presently at a negative yield, actually. And in order to improve our financial risk profile, we don't want to do anything because we are already there, actually exceeding all the parameters, but we will improve our business risk profile gradually, which has another aspect. A hybrid bond, which we haven't touched on yet, but it's another instrument that we are using, is typically rated 2 notches below the company rating. So if I am BBB+, my hybrid bond will be rated investment grade, giving me a better interest rate and also a longer duration. So from that aspect, it's crucial to us, and it is also crucial to our investors.
Fair enough. Another question that's actually a question investors ask quite a lot. Why we have a lot of, within the convertible universe in Europe, we had a lot of real estate company issuing converts. And I think in terms of number of issues, it's the biggest sector represented within the universe. So why would you say it's an attractive product for real estate companies?
Well, real estate, especially over the last couple of years in Germany, has become an extremely reliable and stable market because the demand on affordable living, to use a German word, which they like to use, and the government is supporting that through regulations that we do not necessarily like, but those regulations are not a competitive disadvantage to anybody, so we live with them. But there is a demand outstripping supply by far. The cost of our assets that we are having at the moment is about half of the rebuilding cost. So it's totally unattractive to rebuild. The pressure will remain on the market, and therefore the real estate market in Germany is very stable, and convertible bonds provide a very good solution for the sector with good fundamentals and with positive outlooks. Okay.
Another thing that I was wondering about, and it's something that Grand City was the first to do of recent years, is the coupon step up, dependent on the rating improvement. Why did you guys do that?
It is, number one, something that gives the investors great comfort that we are putting our money where our mouth is, if I can call it that. We are saying that we want to improve our rating. Our business strategy is improve rating. We are communicating this, and we are doing whatever is necessary to put evidence to this effect by saying the coupon will change if we do not achieve a certain rating within a certain time. And this is, number one, something that is very good for the investors themselves. They feel comfortable that we mean what we say, and it also kind of beams internally into the company because everybody is now focused on exactly this goal and keeps that goal in mind in everything we do. And that's both for the investors as well as for our company a very important aspect.
Yes, I can actually relate to that. A lot of people were very keen on this feature because we haven't seen it in many years within the convert market, and it gives great comfort. People are looking, at the moment our market is very, it's a small universe if you compare it to other, let's go to a slide just to give you an idea of the market in general. So I think it's this one. We have the convertible universe in Europe represents about 80 billion euros, which is very small if you think about the straight bond market or the high yield market. And many investors are keen to see new issuance, and we have seen a few this year, but the maturities are coming up, and we're not seeing a lot of issuance to kind of compensate the amount of convertibles disappearing. So primary market is a very good environment right now for corporates to issue convertible bonds because there is a huge demand. And then when you come up with a convertible that has features that are quite unusual that compensate the investor, then you have pretty much a rush to buy the convertible because the pricing is favorable to the investor in a market where demand is higher than the supply. Great. My next question for you is, how do you achieve a balance between diluting your shareholders and then achieving your cheap financing? How does that work for you? Because that's a concern that many corporates have, the dilution that they will experience by issuing a convertible bond, even though that's delayed.
This is an issue with also the investors that we are dealing with. Each time we come with a capital increase, some come and scream and shout and say, we are diluted again and how bad this is. And also when we do a convertible, that happens because they kind of calculate that in 2 years' time or 3 years' time they might be diluted, if that happens. The answer to that is very simple. There are two very misunderstood stories about Grand City Properties. The one story is that we are different to the other property companies because we achieve much higher NOI yields on the work we are doing, because we are not out there buying companies at a premium to their NAV, and they are traded at a premium to that. So we are buying at a discount to V in NAV and create the V. Subsequently, we have much higher NOI yields, much higher like-for-like FFO growth possibility in our company than any stabilized company. And that is very difficult to understand by the investor because we are different from the rest of the mob in that respect. The other thing which is typically not understood is if an investor is diluted with his shares, he still will have the same amount of shares that he had yesterday. Yeah. And we are creating so much value on the shares that the dilution effect, even on his dividend, which we pay, and it's 30% of FFO1 that we pay, is a lot less the effect than the value add on the price per share. And we are outperforming the market and creating significant price per share increases, and that's from what the investor benefits mostly. Absolutely.
So you would say it's a misconception, and it's just because people don't necessarily understand the dynamic of a convertible bond that it's scary, and you have to look at it from like a value perspective in terms of share price. Absolutely. It needs explaining in as much as our share price, since ever we started, has grown by more than 600%, and that's now 4 years. That is true. Other companies don't do that, and that's what you need to keep in mind when you say, I'm diluted. So, I'm diluted on my shares, but I still have my 100 shares, which were yesterday 10 and are today 20. What's wrong with that? Yeah, I would take that trade. Right, so what would you, what's your view at the moment about the convertible bond market compared to the straight bond market, and where do you see value in terms of your future financing plans or the recent issues that you've brought to the market? As I mentioned in the beginning of our conversation, we will look into every aspect, into every tool that is available in the market in the capital market for financing. So we will look at convertibles and we will look at straight bonds. We will look at tap-ups of our existing convertibles, of our existing straight bonds, of our hybrid, of our bank financing. Since we are playing everything, we believe that at the moment for us, convertible bond or straight bond, the pros and cons kind of trade off in each other's instrument, and we are using both with no big preference one over the other. Okay, but and in terms of demand that you see at the moment, would you say that it's stronger on the convertible bond market or the straight bond, or is it for you it's pretty similar? The straight bonds and the convertible bonds that we have done, they have been oversubscribed by huge amounts in an overnight book building event.
So there is interest in both. For us, it is important that whichever we do, that our rating does not get affected by it.
Okay, so that's something that you're keeping an eye on.
There's a question, maybe?
Sure. I can.
Yes, good morning, Orban. I actually have one question because Grand City Properties is like a growth company. So I presume you have a price to book which is north of 1. Would it make a difference if you wouldn't be a growth stock and you had another kind of price to book in your calculations or in your views using this product, the convertible bond? Thank you.
It's right, Grand City is a growth story. If you look at our share price, it is traded at a premium to NAV today, but we believe it is traded at a discount to future NAV. Our NAV right now is roughly 2.2 billion, and we are traded at, today it's 2.6, 2.7, but it was a bit higher already. But we know that like for like, our existing 80,000 properties, once we have done the workout, meaning reduced the existing vacancies of 10% and brought the average rent per square meter from the 5.3 where it is today to 6.5 where the market is today, and we take ourselves 5 to 6 years to do it because within the regulations, that's how long it will take. You can only increase by 15% in 3 years' time. But once this is completed, our existing portfolio will increase in asset value by about 1.5 billion. And that reflects in the future NAV, and therefore I say we are traded at a discount to the future NAV, but the market already pricing in that we have an upside and therefore is trading us as a premium to existing NAV.
Thank you. So here you have a few details. I'm not sure if you guys can see it, but Christian, you recently issued in February a new convertible bond with a 45% premium, which is one of the highest amongst the ones we saw as of recent issues, and a coupon of 0.25%. Which of these two pricing factors would you say is an important one for you, and why?
Number one, the 45% we believe shows a lot of investor confidence in the company, and we also have a call option on this one, which the investors also accepted. And as I was mentioning, we had a good share price development. At the moment, it's a bit flat, but we believe this is the overall market situation because we are not the only ones who are a bit flat at the moment in the sector. And the fact that we could get it at 0.25% coupon and that it is presently, and we keep it tradable for our investors also to be able to trade it, trading at -1%, we believe is a win-win situation for the investors who project their confidence in the company and for us having a very, very low cost of debt.
Absolutely. So that's just an example of pricings that you can achieve in the current environment, the convertible bond market. In terms of investors, we have two types of investors in the convertible bond universe. We have the long-only investors, so people who would buy a convertible bond, hold it on the basis of the equity story, and then follow through with their investments and try to capture the growth. And then we have hedge funds who would buy the convertible bond and then hedge it by shorting the stock, which is selling the underlying shares to achieve some revenue and trade some, do some arbitrage about that. What is your preferred investor base, if I can say it that way, and how do you try to achieve the balance between the two to keep the convertible bond liquid in the secondary market and also have a solid investment base that will be there for the long run?
Well, obviously the preference is to have a high portion of long-term investors. There's no question, but at the same time, we try to keep our securities liquid and give new investors a possibility to come in and enter the success story. And we do not see an influence on the performance of the stock itself as a result of this. And we are actually always, with our capital market activities, trying to attract new investors and pricing it also in a way that new investors come in. And very often existing investors who want to come in much higher than what they ultimately get end up being unhappy, but they understand that the broader the investor base, the better for the company.
Absolutely. It's funny because when you have a new issue, usually it's very much oversubscribed, and then you have to decide how to split your the size you want to issue between different investment base, which is the hedge funds and then the outright investors. And then it's always a process. I think my next question that will follow up would be the index question, because we have indices in the convertible bond, and a lot of long-only funds would follow these indices and invest based on that, the perspective of the convertible being included in those indices. How important is an index inclusion for Grand City? And do you take that into account when you're issuing your convertible?
We take that absolutely into account. As with the rating step up, Grand City is in constant dialogue with their investors and seeking to increase financial comfort to our investors. We do see that this has a positive effect on our pricing. Moreover, we are confident in maintaining these covenants, which we are putting in there, as we have a conservative financial policy and want to maintain it, and we typically have more headroom that the covenants are asking us to have.
Okay. Perfect. And I think we pretty much went through most of my questions for you. The only thing that I would say was, when you're considering issuing a convertible bond and then you're going through that process, what is important for you in selecting the banks you work with? That's like a bit of an impromptu question.
No, actually, we have a minute extra. I'm very happy that it's not as tight as we thought it is.
And then we'll take a few questions.
So I can go a bit back. When we started with Grand City, it was a private company for about 6-7 years. And then the company was listed. The main reason to list it was to gain access to capital markets. When we started with this activity, we were a small company. We were a $500 million market cap when we started, and we were sitting with investors, with analysts, and trying to convince them of our story. And we were almost politely pitied by these analysts, saying, look, we've got companies 1 billion, 2 billion, we have to cover those first. I mean, wait your time, kind of thing. And we were trying to preach that we have a story which is different from the companies that they are looking at, and coming in early, analyzing it early, providing their investors with the information about the company might be also an advantage to them. And now there is in the market one analyst who is very well known and very reliable for properties, and that gentleman is called Kai Klose, and he happens to be from Berenberg. I'm not saying it because she is next to me, it's just the way it turned out. And he was one of the first who really analyzed us, and who we learned how one is being analyzed, because we didn't know that when we started, and what questions are being asked. And he went really very, very deep into it. And then gradually we had more analysts, and meanwhile we are at almost 20, was it 18, 19 that we are having at the moment, who are covering our stock. And we find that is very important for the investors, for the capital market, and also for us. And we are trying to be as open as we can with our investors. They can call us anytime, and we answer their questions that they want to have, because it is very important to provide our investors with information and then with tradable instruments that they can make use of. And the company that originally was supposed to be listed is called Aroundtown. Aroundtown is a company that has commercial assets, residential assets, and hotels. When we tried to list that company 4 years ago, the market told us, don't. They are only the market is only interested in residential. So we carved out residential and called it Grand City. Around Town only listed half a year ago and is a bit today where Grand City was 2-3 years ago, starting it all up. But they learned from what happened with Grand City, because it's one family, and got first listing investment grade, and are now doing exactly what Grand City has done, get coverage from analysts, put out convertible bonds, bring up the liquidity in order to make that a company with more, with a higher proportion of free float.
Thank you. Do you have any questions for us? No? Yes? Sure.
I have a question on the step up. So my understanding is that most companies issuing convertibles are non-rated. So do you expect that over the life of the bond, the company will then become rated? First question. And second question, if a company reaches a step up, so for notch or even 2, what would be in basis points, let's say, the coupon gain you have as a issuer? Thank you.
The company is already rated, so it has not issued a convertible bond and then later tapped it up after being rated. It was rated when it did the convertible bond, but what we have said with our bonds is we are presently rated at, and when we did it, we were double B or double B plus. We said if within a certain period of time we do not get an upgrade in our rating of 1 notch, the coupon will increase by 0.25%. So that's the way we threw in something for the investors who said we would have preferred to, I think it was when we were not investment grade and about to get the investment grade, where we wanted to show to our investors, we are confident we will get investment grade. So what we do is, we treat this bond as if we are investment grade, and if we don't achieve it in a certain period of time, we will give you extra money as if we were no investment grade. So this is the correlation there.
I must say that's quite unusual in the convert market, because usually you try to achieve as low as possible coupon, and then you just keep it at that level. But then I guess Grand City has confidence that it will achieve a better rating in the future, and therefore they targeted an even lower coupon payment initially, saying, hey, if we don't achieve the rating that we're promising in the next couple of years, it was 18 months, I believe, right?
On the last one, it was 18 months.
Yes.
On the one before, it was even shorter. I think it was a year.
Absolutely. So we will pay you up a coupon that's higher than we're willing to pay today. And I guess the target now is to achieve the rating.
It's an absolutely declared target to get in our rating, triple B at the moment to triple B plus. And we believe it will happen within a year, hopefully within this year. And the next one will be to A minus, which will probably take another 2 years. The reason we say it, we know exactly, not exactly, but pretty well how that works. And the company has been upgraded from its initial double B minus rating 4 times every half year because of the performance of the company. And with hindsight, the only thing maybe was we were very keen to get a rating. And we were the first mover also in the residential market to get a rating. And maybe we pushed it too early and started at too low a base with our impatience. So we needed to work hard to go up there. With Around Town, we didn't make that mistake. And we said, let's get the company onto a footing where it does get an investment rating minimum at the starting point. And this is what we achieved.
Yes, sorry, just one small question. I see total size here, 450 million. How much actually of total funding does it represent, your convertibles in your total funding package of your portfolio? How much is possible to use basically, because obviously you optimize also for rating purposes. I was just curious, Sofan, if you
Our
have some
bonds is about half, so it's about 30%. Very,
30%.
very rough figure off the top of my head, because our bonds, bond financing is about 60% of our financing comes from bonds, and the rest is from bank financing.
So basically, over the next couple of years, your capital issuance will be done by the convertibles. You don't need to.
Most likely, yeah.
Okay.
Plus, we have at the moment, since we did a capital increase end of last year, 150 million was a small one. We did the convertible bond. We have at the moment about 650 million firing power sitting there for new transactions. At a time where we see that the market is not as fast as it was last year and the year before. So we believe that we are okay.
So I would add to that, like most companies usually issue convertibles when they want to increase their free float, but they don't want to do it straight away. So that's a way for them to have like more shares outstanding at the end of the life of the convertible. But also that's for the smaller companies. But then when you have investment grade companies that are like multi-billion market cap and they're trying to get financing for free, pretty much, what they would do, they would issue a convertible bond with a 0% coupon, so you're not paying anything to the investor. We've seen that in many instances as of the recent issues like Total, BP, Airbus, etc., which are like companies that everybody knows. And then with, I would say, premiums around between 60 and 75%, which is pretty much unheard of since 2000, I think, and 2 in the convert market. And at the same time, avoiding dilution by buying back options with the same strike of the convertible bond. So it's pretty much free financing for corporates when you manage to achieve a 0% coupon. Okay, we thought we'd do a little tap dance for you at the end of it, but the floor is not very appropriate, hard enough. So we thank you very much for having joined this. I hope you found it interesting, and it gives us a safe cushion to make our flight. Yes, perfect. Thank you, guys. I'll leave the page with our details if you have any further questions. Thank you.